Good afternoon, ladies and gentlemen. This is Michael Camo from T3 Live. Welcome to today's event-driven options trading, your profitable solution to market chaos. Can I get a quick sound check? Can everybody let me know if they hear me? Okay, thank you, Hank. I'm going to put our disclaimer on the screen. We've got a packed house, but there are still people coming in the room, so please read the disclaimer. Basically says, trading is risky. I'm sure you know that, but we have to leave it up here anyway. So where is everybody from? Okay, San Diego, California, New Jersey, Atlanta, Seattle, Austin, Brazil, Israel, Canada, Arizona, Ohio. So pretty fun, even North Carolina. Okay, so we haven't done an options webinar in about 6 months, and this is a different kind of webinar. We're not going to spend 3 hours on implied volatility, time decay, gamma scalping, how the VIX is calculated, how you can make a call spread. Instead, we're doing a topic we've never done before, so that's event-driven options trading. I hope you'll stick around because we're going to make a special announcement later on. We're also going to hold an in-depth Q&A. We have packed room, so if you have questions, make sure you get them in. We're going to get to as many as possible, but we can't promise everyone, so just get your questions in. Okay, so our moderators tonight are Dan Darrow. Dan is a professional options and equity trader. Is anybody here on the VTF? Yeah, so if you're on the VTF, you know, Dan's probably our most popular options trader on the VTF. He's got over 11 years of professional trading experience. He's a specialist in event-driven strategies. He's always focused on stocks with major news catalysts. So he's all over earnings, FDA announcements, you know, drug announcements, economic data, all those things. And we also have Kurt Capra. Kurt Capra is a T3 Live trading strategist. Kurt is my personal technical analysis guy. Whenever I have a question about charts, technical analysis techniques, setting targets, stops, support, resistance, all that stuff, I always go directly to Kurt. So we have a limited amount of time, so I'm going to pass the mic over to Kurt to take control.
All right. Thank you, Mike. Can you guys hear me? Just want to make sure before I get started here that you guys can hear me. All right, cool. And you should also see the slides go through these first couple here. So, all right, cool. Appreciate the feedback there. And, you know, guys, I want this to be interactive. So if you have questions, I know Mike said, you know, we'll address as many as we can as we go on. But as far as just interacting with me, the more that happens, the better this overall experience is going to be, you know, and not just with me, but also with Dan. So definitely,
who is here also, hey guys?
You know, let us know what's going on. Yeah, Dan, I heard him there in the background. He's here with us also. So like I said, you know, we're tag teaming this. Definitely want you guys to participate and interact as much as possible. So with that being said, do you guys remember these headlines? You know, Wall Street's fear index, the VIX, falls to a record low as traders maneuver after the Fed statement, or 2017 was the least volatile year in decades, right? You guys remember reading about, hearing about, seeing these headlines? I mean, I got to believe that if you are anywhere near the market, you've got to have seen or heard about these headlines and really experienced them. Right? Experience them yourself. The market was just grinding its way higher day after day. It was, you know, it was really slow and for some traders maybe even painful because a lot of people just, they didn't believe it. They didn't trust it. The market's just grinding higher. Everybody's talking about, you know, things are getting ready to fall apart, this and that. And, you know, it just kept going. So it was, like I said, frustrating for some that really didn't know how to handle it. And that's, that's one of the nice things about options that we're going to get into is that no matter what environment you're in, whether the market is just grinding higher, whether it's collapsing lower or going sideways, Dan and I have strategies between combining the technical analysis, the news flow, the options all together to make you guys money, and of course us as well, because otherwise we wouldn't be doing this. But anyway, right, we all know what was going on with volatility, and then all of a sudden things changed, right? Over really the last week and a half or so, things changed. You can see here, this is the volatility index, huge, massive spike. And Dan and I were prepared for this. I mean, we actually, not to gloat, but we actually nailed this trade. We were able to play the VIX to the long side, and we were also short the market. We had short positions in the market. I'll let Dan get into some of those, or if you guys have questions about those, we can get into them later. But, like I said, we saw this change coming, and it wasn't like we were talking about it a number of different times leading up to it. We saw it coming, and we alerted people really in the days prior to the explosion in volatility. And so, like I said, something changed, and there's really only one word that we can use to describe that change. What do you guys think? What is the one word that you can think of that best describes what's going on here? I see correction, ridiculous, interest rate, uncertainty, insanity. Yeah, I mean, those are all definitely words that can be used to describe what's going on here. But yeah, I mean, as somebody just said, tsunami. As somebody just said,
is that Daniel D? Do we have a Daniel D out there?
I guess so. We do. Opportunity, right? Opportunity is the one word that we really want to be focused on. I mean, not to say that what you guys said isn't correct, because it was a crazy move. There's no doubt about that. There was definitely some insanity there. But opportunity, especially as options traders. Now, as an equity trader, there may have been some more pain felt with that kind of explosion in volatility, especially if you weren't prepared for it. And quite frankly, I mean, those pullbacks that we saw were quite severe in the actual stock. But if you were positioning in the options with the mindset that, risk is definitely increasing, even before the explosion in the volatility, risk is increasing. So there's opportunity to make money there, right? So like I said, options are an extremely lucrative way to not be completely exposed, if you will, to the up and down movements in the market, right? You can make money with options, yes, if it's going up, if it's going down, but even sideways, right? There's so much opportunity that is out there with options that you just, quite frankly, don't have with trading the actual stock itself. And we're going to get into that here as we move on, and as Dan gets into some of the trade examples. But I want to give you a flavor for what we do and kind of how we approach things before we start showing you those actual examples. So some basic things that we can certainly agree on. Volatility is rising. We've already seen that through the chart. There's no question about that. This is great news for options traders, because it means there are going to be more trading opportunities. There's going to be more trading opportunities for us to take advantage of, which also means bigger opportunities to profit from, right? If things are moving if things are moving fast and getting to targets quicker, not only do you have bigger opportunities to profit, but you've also got, as I said, more opportunities. Where options traders are going wrong right now, however, is they're still trading options like stocks, right? They're looking for that either up or down direction. They're too focused on needing to pick up or down that specific direction, as I said, and ignoring catalyst type events. So as we kind of already hinted at, what worked after the election isn't really working the same way as it was, at least not right now. And so you need to, again, have an approach, have a method that allows you to take advantage of all types of environments, regardless of what's going on. And so the 5 reasons that we love the event-driven options trading arena is because, as I already said, rising volatility means bigger moves around events, more money to be made. And you can see these opportunities coming. All you got to do, one of the things you have to do is look at the calendar, and it's filled with different events. You've got earnings, you've got economic data, central bank events, upgrades, downgrades that come out. We have plenty to go off of. So, and we don't need to be right on the market direction, especially when you're looking at these news-driven type events, because stocks that are being driven by news are going to be on their own page, so to speak. They're going to be moving independent of the market. So like I said, you don't need to be right on the market direction, because when you're trading these catalyst type events, it doesn't matter what the market's doing. So if you're focused on trying to time your trades with the market, you're missing out on a huge opportunity. So the 5 ingredients for a powerful earnings trade. Right? Let's go through 5 ingredients for a powerful earnings trade that we consider, Dan and I consider, as part of our analysis process.
Yeah, and just these are just 5, so it's by no means totally comprehensive. I mean, there's a lot of inputs that go into selecting a trade, but these are 5 that tend to pop up a lot that we kind of highlight as important.
Yeah. So like Dan said, not limited to, but these are some of the bigger ones that we want to consider, is how the stock performed versus expectations after, say, the last 3 earnings reports. A recent example that I can think of is Apple. We were able to take advantage of Apple prior to the move lower, and this was part of it, how it behaved prior to earnings. So there's one way in which we were able to take advantage of this prior performance leading up into earnings. Implied volatility relative to historical levels is another consideration that needs to be made. Also, what kind of fundamentals or news can trigger a bigger technical move? Obviously, earnings are going to be a huge catalyst for movement. And like I said before, you don't have to be backing yourself into a corner and picking a direction. You don't have to say, oh, I think this is going to go up, so I have to get long, or I have to go and buy calls. No, you can do things with options that allow you to just say, you know what? I know this is going to move. Now I need to figure out what makes the most sense to take advantage of that expected movement. All right.
Yeah.
Another one, unusual options activity. Right. That's something that Dan definitely takes a close look at and takes note of, because you know what, if you can spot unusual options activity with a good technical picture, along with some of these other events or factors we're talking about, it can really lead to some big money making potential. And also, arguably, what could be most important and make and break the trade is what strikes and expirations are going to give you the maximum reward versus risk. So again, these are some of the main things we want to focus on, but not all of what needs to be considered. So like I said, I don't want to bore you guys with just reading through the approach. It's going to be much more exciting for you guys if you see some actual trade examples and how things worked out. So I'm actually going to hand the mic on over to Dan, and he's going to walk through these earnings trades and some other trades, not just earnings, but he's going to walk through some of these with you. Okay, so I'm going to hand this on over to Dan, and he'll take it from here.
Hey guys, you can all hear me? We're good. So you know, like those 5 ingredients, right? Like when we talk about like what we look for, there's definitely a handful of like kind of ingredients that make up like a good a catalyst trade, right? Basically what we look for, I mean, so for instance, like Facebook, right? Like everybody's like, oh, I know I know Facebook is going to beat, right? Like everybody knows Facebook is going to beat. Like Facebook has beat every quarter since 2012. So what are you going to do? Go out and buy calls? But like like the problem is like everybody knows Facebook is going to beat, and like the stock is just is priced for that. Like the options are expensive. They tend to not pay. And as much as you could have conviction in like you know, an idea of like a company is going to do this, or like they're going to have blowout print. I mean, there's so many more things that kind of go into it. So like, you know, like what we're going to talk about tonight, it's some of like what we look for, and kind of like a highlight and what makes like a kind of like an attractive trade, right? Like so like the like the ones that we're going to go through are just some of the examples that worked, and we want to kind of like show you why those worked, right? So the first one up here is LITE, LITE. So this was like a recent example. This was a recent earnings trade, and this trade we did a strangle. So we went long a call and a put, basically, you know, one further out of the money on the upside, one further out of the money on the downside. And what we were looking for was just basically a big move. We wanted a big move. I going through, you know, kind of like screening going into like going into the week, like I saw LITE, and like, you know, I've known that it's moved in the past. So, you know, when I first pulled up the option chains, I was looking at it, and it just seemed underpriced. I mean, like sometimes like things just aren't priced correctly, right? So like the previous couple quarters, it moved quite a bit more than what the options were pricing in this quarter coming up, and you know, it was sitting at like a critical technical level. Like short interest was rising. It just seemed to be mispriced. And what's interesting, and kind of like to circle back to, you know, what Kurt was saying, is like we don't need to know the direction of the market. Like this is like a market agnostic trade, right? Like the trade can behave completely independently of what the overall market is doing. And LITE, the reason I want to highlight it is because it's a good example of that. Like we went long the strangle, right? And you know, they had really killer earnings. The stock jumped, and it went on like a nice 2-day run, right? So we went long the strangle, 235. We sold it we sold the call at 510. I mean, obviously the put's not worth anything because it moves so sharply in one direction. But what's interesting is that like last week was when the market was like down 1,000, up 1,000, down 500 points, up at 500 points. It's basically like this trade behaved on its own, you know. So that's why like there's all this potential. Like we don't need to like pick the direction of the tape. Like I don't particularly care if the sweaters are up 2 points or down 2 points. Like I want to find like the setups that are attractive. So when we're screening, you know, it's like you kind of get like these inputs, and you kind of, you know, see like setups kind of like tick off like a number of like these, like kind of what we look for, like the unusual options and like the technicals, what it did last quarter, what are they pricing in, stuff like that. So that's why I thought LITE was like a good example of that, and it just goes to like highlight like what we're talking about. It's like, don't need to know the direction of the market. Like as long as there's like news, money is gonna be moving around. So it's more about like picking the right setups. So like the next example we have is actually it's another earnings trade too, right? So I talked about this in the VTF for all your VTFers out there. We talked about this in the VTF going in. Like this was like a Blackberry was it probably is one of our favorite like earnings type setups, and it's kind of what we call like a combo trade. This is like one of those like things you screen for. I mean, it doesn't always line up, but these are like what we call a combo trade, and basically Blackberry was kind of similar to LITE. It was like it was a stock that going into report was the options were priced less than what it had moved the previous 2 quarters, which you kind of look at it and you scratch your head. It's like okay, like Blackberry moved $1.50 the quarter before, 2 quarters ago, moved $1.10 last quarter. So why is it only pricing in like 85 cents? Like it doesn't make any sense, right? So in addition, when you're doing like these earnings trades, you kind of want to look for like you kind of want to look so for like these combo things, right? So so what I mean by that is that like you have like this earnings priced in move, and then when I kind of like look at the trade, like look at the chart, like Kurt and I look at charts, and we're saying like, oh, it's like, so you get like a priced in move, and then there's like a really critical technical level that it could potentially hit, right? So like Blackberry goes into earnings like around 11, and like you're priced in like 85 to 90 cents, but what the option market isn't pricing in is the 4-year resistance at 12. So you figure like if the number is good enough to get it to 12, then there's a chance that it could break out. And then when you have like a priced in move plus like a 4-year breakout, I mean, like that's kind of like what you call like the combo, right? So you get like almost like a 2-for-1. And Blackberry, like looking at it, it worked out well. I mean, we went long, and it had like nice 1-day pop, and then pulled back, and then it just ripped. I mean, it had some like headline too, which like sent it like roaring higher. But really like that was set up by earnings. I mean, it was, you had like this strong report and then like a major technical breakout, and really like the options just weren't priced for it. So it's like you get like these components. So it's like earnings trades are they're more than just like saying like again, like circling back, like it's not saying like, oh, Facebook is going to beat, I'm going to buy calls. Like, yes, that's great, like you think it's going to beat, but there's so many more names out there besides just these FANG stocks, and like there's so many like interesting setups that like when you like screen for these, like they kind of like they kind of like provide like these inefficiencies, and then that's kind of what we're looking for, when we're like looking for like these event style trades.
Yeah,
but also, I mean, like
Dan,
yeah.
if I could just hop in real quick and add one other thing, this trade was $68, right, to get involved on one lot, on one contract. So anybody really could do this. It's not like we're going out looking for these high priced option plays that it's going to be hard to get in, and we're looking for things that are really liquid too. It's not these illiquid options that we're looking to get involved with. This is the way Dan and I try and approach this, is literally anyone could do it. Anyone should be able to get involved regardless of their account size, whether you're looking to trade 10 lots or just get started with 1 lot. And like I said, you could have gotten into this trade on 1 lot for $68. And as you can see, it went on to make a net gain of 267. So I mean, the return there was just incredible. And I see somebody asking, could this have gone the other way? It absolutely could have gone the other way. But the nice thing with options is that the risk is contained to price paid, right? I mean, so I just want to come in, just throw that little insight into there, but I'll give it back to Dan here now.
Yeah. So like Kurt said, I mean, like, you know, we'll touch on it. We'll touch on it like later. And you know, I know like there's you guys have like a ton of questions, and you know, we're gonna try to answer, like, you know, we're gonna try to answer as many questions as possible later. But like, you know, it's a good thing to stress, like Kurt said, like, you know, like these are trades that don't require a lot of money. You don't need to have like a huge account. You don't need to take on a ton of risk. You know, part of what we do in like the letter, and you know, I don't want to get too much into it now, but it's just like we try to keep like our risk more or less even. I mean, we want to, you know, like give like ideas that are you know, they're not always gonna be the exact same dollar amount, but they're around like a certain range. So you know, you don't have to have a huge account to take advantage of them. So, but we'll get more into that, like, you know, later. I'm sure a lot of people have questions on it. So you know, getting back into it here, like, so other type of events, right? I will say it. I am a biotech guy. I love biotechs. I mean, anybody that on the VTF or has been on the VTF or has been anywhere near the VTF knows I love biotech plays. I love everything there is about biotechs. So FDA, drug news, analyst events. The JP Morgan conference is, you know, almost as good as the holidays for me when it comes to like stuff like this. You know, the beginning of January, like so much going on. But you know, upgrades, downgrades, it provide opportunity. Economic data releases, like think about it. Think about what, you know, if any of you guys were watching the market this morning, you know, think about what the CPI number did. I mean, it knocked the market down, like it knocked the S&P down like 4 or 5 points. I mean, so it's you know, like, especially with volatility picking up, like there's going to be more opportunities. Government actions. I mean, Trump. I mean, need I say more? I mean, you have like the new tax plan, you have infrastructure bill. I mean, Trump's private Twitter account. I mean, just so much going on. M&A is great. Again, like circling back, like biotech, like I love it. It's going to be a lot of M&A coming. And then just industry competitor news. I mean, like, you know, I suppose like industry competitor news, you could just put like, you know, I could just get rid of that title and just say Amazon, right? Like it just seems that like Amazon has created like an entire type of trade on its own, like Amazon. I mean, it's almost like a verb. Like the amount of money that moves off of, I mean, not just specifically Amazon itself, but like the amount of money that moves off of Amazon entering like an industry is crazy. I mean, and it seems like it happens like once a month now. I mean, you get, you know, Amazon entering the healthcare space, like a $300 billion worth of market cap is erased off of a healthcare stock, just by the fact that Amazon might be getting into it. So just, you know, always stuff going on. So you know, like there's so many things to like screen for, like these events, right? And like those are kind of what we're looking for. I mean, like that's kind of what we focus on. Like, you know, we do make money. We do make money with like just technical swings, but like we love events. We love events. So like, you know, going back to this JP Morgan conference, right? So at the beginning of January, you have the JP Morgan conference, and it's like a biotech, pharma, healthcare bonanza. You know, you get guidance, drug data, M&A. I mean, it's just like a cornucopia of like news. It's fantastic. So Illumina is a name. I mean, it's one of the names I follow, so you know, I'm definitely familiar with it. But Illumina, it's a stock or a company that almost always gives guidance or some sort of like company update. So it's not necessarily on the calendar, and it's not like an earnings date is like set in stone. Like this is they don't have to do it, but they tend to do it. So like, when the calendar gets down to like the end of the year, and I start planning, or we start planning for like this conference, Illumina is always a name that pops up. And the reason why, so we actually got involved early. So we got involved end of November, beginning of December, and really the reason why is because like the market was acting great. Like it's technically, so you'll see that like some of these plays, it's kind of like a combination of technicals, a combination of a few things. So it's technicals and events, which we have on, events we know are coming up, and options, and there's all sorts of things, right? But Illumina was one. So we were screening, and it looked like it was about ready to break out. So like we knew that there's a big catalyst coming up, and it looked like it was ready to break out. So we got involved early. And what you'll see is that like a lot of times, like when we do this, like our positions are like out through events. So like if you follow us on the Facebook Live videos, you'll see that, we talk about like, we talk about going through events. So like going through earnings, or going through an analyst or investor day. And in this case, like the Illumina trade, we got involved in November, December, and the trade was out through January, knowing that this JP Morgan conference was coming up, and there was a very, very, very high probability that there was going to be a major catalyst, right? So we went long a January call spread, and we sat in it, right? Like it kind of like it went up and it came back, but basically the whole time we're sitting in it, we knew that like, it went up, it came down, but like the reason why we got into it still stood. So there really was no reason to cover when it went up and came down. And what happened was you got like a late jump into the conference, and then they gave strong guidance, and they announced the next generation sequencer, and then the stock popped. And so, like our call spread, which cost 330, we sold for 1270, and I mean it was a huge trade. I mean it's great. It's like, and it's just knowing it's the defined risk, right? Like we knew what we were risking. So yes, of course there's always risk with trading, right? Like if it went the other way, it wouldn't have worked out for us. But options give defined risk. We had a defined risk. We had a defined strategy, and it worked out fantastic. And like these are the types of things we're looking for. Like one of the next ones. So VMC. For all of those that aren't familiar with VMC, it's a cement aggregate name. And what's interesting about VMC is that it's kind of, what you would kind of throw in the category of like a Trump trade, or at least, that's kind of how we refer to it, or people refer to it. And what I mean by that is that, in the immediate aftermath of the election, right, you had just a ton of money moving around. And basically that was when like the smart money, quote unquote, they basically like, they put money to work in areas where they thought that were likely to benefit from President Trump's, agenda, right? So what happened was you had steel stocks, a lot of stuff went up, but like steel stocks, these aggregate names, the heavy machinery. So like these were all like, in terms of like kind of like plays for his infrastructure. So when, like the infrastructure like talk started to like gain some momentum a couple months ago, it was almost like we had like a roadmap already laid out for us. Like we already knew what was going to move. We knew the names that were going to move because they already tipped their hand right after the election. So when we were kind of screening for plays going into this infrastructure announcement, VMC was one that came across our radar, and like it was in like a decent technical range. So we got involved on the breakout here. As you can see, like we got involved when it was kind of in the consolidation, looking for breakout. It popped, and then went on like this really nice run as people kind of like bought into the entire idea of like, there's going to be a huge infrastructure announcement. We sold, so like part of the nature of this was that it was a call spread. So when it got up to like 140, our upside was more or less capped. So like we cut it loose. So we actually didn't even hold through the actual State of the Union announcement, but it didn't matter because like the trade had already played out. Like, you know, you knew what the catalyst was going to be, and you kind of like screen, and you have like these like this group of like things that like you kind of like tick off your list that say like the thing makes it attractive. It's, you know, it's like technical, like there was I think there was strong call buying on it, and you know, like this was one that worked out, but we were also in Steel Dynamics, which worked out great. Like we were still in Ingersoll Rand. I mean, there's other things where, you know, like it's just about like knowing like when the news is coming and like when stuff is going to react. And you know, it's like these are the types of things like we're screening for, like plays like this. You know, and you know, as we like kind of wrapped up in the slide before, I mean, like the calendar is just this constant source of new trade ideas. I mean, there's always something coming up. So as long as there's news or scheduled news, there's always going to be like new trade opportunities, and that's what's great about like the events and like trading these events, and that's part of why we love it, and that's part of why like we are so like enthusiastic about doing this. So yeah, so now I'm gonna hand it back over to Kamo. He's gonna do a quick recap, and then we'll come back on a little bit to do some Q&A. So Mike, you want to take it from here?
Okay, thank you, Dan. Thank you, Kurt. Thank you for an excellent presentation. So what you're here for is event-driven options trades. And we're giving you the opportunity to get Dan and Kurt's all the trades for a ridiculous price. Now, the big picture here is Kurt and Dan do all the work. The most important thing to remember about events is that there's so many of them. I mean, if you think about, there's probably about 1,000 companies with options that are worth trading, meaning they're liquid enough. Then you've got dozens of upgrades every day, or just earnings cuts, earnings boosts, central bank meetings, FDA news, conferences, the big guys' tweets. They also figure out the specific options contracts with the best risk reward, because I mean, if you look at a stock like let's say Amazon, if you were playing it off that healthcare announcement, you're talking about maybe 15 different expirations, 100 different strikes. So you've got thousands of events, thousands of options to choose from. And Kurt and Dan basically hand you the plan in plain English with the specific action you need to take. Then, aside from all the event-driven trades, there's also technically driven opportunities. Sometimes a chart looks good, an option is mispriced, and they see the opportunity right there for you to grab it. So the main thing with options plays, obviously, it's a newsletter. It's delivered once a night. You get trade ideas, clear, simple instructions. So you know, for example, you see right on the screen, CTSH, which is Cognizant Technology Solutions, long call, the contract listed, the price, and there's also going to be opportunities the team has on the radar, and a review of all the open positions, so you know what's going on with all the positions. Then there's also intraday alerts, which is basically usually about 2 to 3 a day. When there's an update, for example, when it's time to take profits, when it's time to roll a contract over to a new one, if there's a new trading opportunity, you get an instant email, all the information you need. Again, very simple. You could see sell the call for 4:30 or more, and then that's pretty much it. These trades aren't complicated. They're not hard to put on. Then everything is transparent and ease of use. We update on all the trades. We actually use liquid options so you can get in and out of the trades. You'll see a lot of people, for example, last week, a lot of people were talking about trades on things like VIX calls, talking about sort of paper profits when you couldn't even get in or out, so it didn't even matter. But Dan and Kurt use common symbols So you're never going to have that problem. Also, all the strategies are easy to implement with any online broker. So it's calls, puts, spreads, strangles, calendars, butterflies. You don't need a lot of capital. You don't need a lot of margin. Now, for example, you see some people talking about doing things like shorting put options. On a stock like Amazon or Apple, you might need like $20,000 or $30,000 just to get the trade on. But that's not the case with options in play. You might just need $60 or $100 to do a trade. You can scale up or down as much as you want. Now, so just to recap, you get the newsletter with daily trade ideas, 2 to 3 intraday updates, 100% transparency. Everything as an exit plan, entry plan. Everything's easy to implement, specific instructions. And if you act now, you don't pay 95, you just pay $7. So you can get started for $7. So it's no contract, no commitment. I'm going to shoot you guys over the link right now to check it out. Does everybody see the link? Okay, so this is just a few things people are saying. Melly was recommended on November 26th, made $1,000 per contract. Deb from New Jersey is one of our best customers. She's probably on here. Thank you, Deb. Neil said ideas have paid cost of subscription. Russ from Hawaii, DXCM trade worked out very well. And then Chris from the UK said it's a great tool to get experience trading, and it provides you with specific ideas. Now, again, can't emphasize that enough, that options in play, it's easy to use. The strategies are straightforward. All the plans are laid out. Nothing is confusing. You don't need a ton of money to get involved. Now, if you're talking about like overall performance since September 2017, if you took one lot per trade, you'd have over 21,000 in profits. 10 lots, 216,000. Now, we can't guarantee you can always get the perfect entry, but I mean, as you saw from the examples before, these trades have high profit potential. They're not crazy. Okay, so we're going to go through some before we get to the full Q&A. We're just going to give the most commonly asked questions because people always ask these questions. Now, the first is, how much do you need to trade these strategies? And answer is simple. You can use one lot, which might be $60. It might be $300. It's definitely not 10 or 20,000. Another one. What strategies do you use? Calls, puts, spreads, strangles, calendars, and butterflies. There's no naked short positions, anything like that. Nothing that's going to really knock you out of the game. And again, shorts are only used as part of a risk-defined spread. Dan, are you there?
Yeah, I'm here.
Okay. Yeah, so I mean, a lot of people ask these questions. Like, is there any reason, like, you avoid naked shorting of options?
I tend to not be comfortable with the risk. I mean, there's a lot of ways. There's a lot of ways to make money with option trading, and I just find that like this is what works for me. This is what has worked for me. And you know, a lot of times that I don't feel comfortable taking like the short risk of like the contracts. I mean, yes, like 9 times out of 10 they could expire worthless, but you know, the one time it doesn't, I mean, it kind of like resets all the other good ones. So this is what has worked for me and Kurt, and that's kind of why I recommend it.
Okay, so we're getting so just to everybody out there, we're getting a ton of questions. So, and a lot of people are asking similar things. So we're going to kind of condense them a little bit, just so everybody gets out of this what they need to. So a lot of people are asking, like, do they need to be an advanced options trader to do these trades?
Is that to me?
Yep, to you.
Oh, okay. Yeah.
Whoever wants to answer. Anybody that wants to answer.
Anybody? Yeah. No. So totally not. Like this is so like the way Kurt and I like run this. It should appeal to like anybody that has interest in trading options. So whether you're a beginner, the ideas are laid out like real in real plain simple terms, right? It tells you anybody that has like a basic knowledge of options will be able to do this. But you know, also for those that are more experienced or for professional traders, it's also like it's a great idea generator. Like you can't look at like a million stocks at once. So it's like it's a good way to, like, even if you're an experienced trader, to like just generate ideas like outside of the universe of names you're looking at. So it's simple, it's straightforward, and you definitely don't need a ton of experience. Just like basic knowledge of options is definitely enough.
Okay, about how many trades will people get per week?
So at minimum 10, sometimes more. So usually at minimum 2 new trades a night. And sometimes if things develop quickly during the day, there could be more on top of that. And if there will be like different adjustments during the day as well. So at least 10 new ideas, possibly more, and it could be even like more trades, just as in terms of like adjusting positions on even on top of that.
Okay, so what are the most common, I guess, stocks or ETFs you're playing?
So we do trade a lot of different stuff. So certainly, like, you will see like the FANG name show up in there, but it's not like our primary focus. If they're interesting setups, we'll take it, but it's just it's names that have news or names that will be moving. Like, it's we do a healthy amount of banks, of industrials, bios, and pharma, certainly, like tech. It kind of depends on what's moving. It depends on what has scheduled news, and we don't want to be sitting in like a bunch of utilities. Like it's got to be something that moves, but it's also we don't like limit ourselves to like say like 20 to like 30 names. I mean, it's not just specifically like FANG stocks or like high growth tech. We really have like a pretty broad basket of what we go after.
Okay, a lot of people are asking, is the $7 per day, week, or month? So it's $7 for the first 30 days. Then 95 after that. Now you can cancel at any time. We're not one of those places that keeps you on the phone for 8 hours if you want to cancel. All we'll do is ask you, why is it not for you, and that's it. So it's just $7 for 30 days. You can try it out. You can just watch the trades. You don't have to trade them. See if it's right for you, and then you can take it from there. Okay, let's see. We've got.
Do I take PayPal?
Yeah, Dan, do you take PayPal?
Yeah.
We actually do take PayPal if you want an annual subscription. Okay, so do you use butterfly spreads?
Yeah, definitely. Definitely do butterflies. Butterflies, straight spreads, calendar spreads. Again, anything. Well, mostly anything that's a net debit. We're not credit spreads. Again, you won't need margin to trade these.
Okay, so before you talked about a stock not paying on earnings, like what did you mean by that? I think that was in reference to Facebook.
Oh, so not paying. So when the stock doesn't pay, basically like the way you estimate what the price didn't move for a stock is by adding the basically the closest expiration call and put together. So that'd be like the price didn't move. And for instance, well, just off the top of my head, I would say like I think Facebook was priced in about like $10 or $11 going into this quarter. So if you bought the straddle at say 10 to 11 and the stock moved 6, then you would have lost basically half of your money, because it would have needed to move $11 just to get your money back, and I'm pretty sure it didn't. So so basically, when I say like it doesn't pay, what I would mean by that is that you know, when a stock has like a priced in move and it moves less than the priced in move, then for a lot of option players, that means that it didn't pay.
Okay, so how do you protect against implied volatility crush after earnings? And just so people know what we're talking about, earnings after earnings, implied volatility usually collapses. So how do you protect against that?
Well, I mean, there's not an exact science to it, so you can't like say definitively like this is how you prevent it, but basically what you're looking at is you're looking at like these trades, or what we screen for trades that are trying to basically exceed like that price to move. So so yes, like there's going to be a contraction in the implied volatility, but you know, like if your option is say like 4 or 5 points in the money, it's going to be it's going to be more of like a marginal move, you know, like because like your position is going to be so far in the money that like the contraction, it will be made up for by like the change in delta, right? So that's why like yes, like if you're buying a lot of options, like there is like you know, there's risks that go with it, like, and anybody that trades options is aware of that. I mean, like when you go into like an event or like an earnings, like the implied volatility is going to be higher because the option market is anticipating a sharper move. So but what you're kind of screening for is like the ones that are going to kind of like exceed the expected move and basically kind of counteract what would be like that, you know, that implied volatility contraction, which you will see basically no matter what after like an earnings report.
Okay, do you need a big account to trade these strategies?
No, Kurt and I were just kind of going through. We were going through our like kind of like the entirety of our proposed trades before, and I believe that there was never a trade. There was never a trade that cost more to get involved. I think 500 might even be like the top. I don't think there was even more than like, if there was one, there wasn't more than like three. So I don't, we don't tend to recommend anything, you know, 400 or 500. That would probably be our cap. I think when we were looking at it, like I'd say on average, you know, like the average dollar amount per trade recommended is between $1 and $1.50, if you know, to ballpark it. So you know, for like a one contract, that would be the equivalent of like $100 to $150.
Okay, so how risky are these trades?
I mean, yeah. Also, I mean, every trading strategy, you know, like that's part of the job, right? Is that there's going to be risk associated with any trade, but I mean, really, what it comes down to is you know, these are clearly defined ideas. Like there's a reason we get involved, and at the end of the day, like part of the benefit of trading options is that your risk is your max risk for like those options that are like net debit is your max risk is always going to be the price that you paid. So you know, when it comes down to it, like yes, you can lose what you paid, but that's all you can lose. Like you're not shorting, you know, naked options, or you're not shorting stocks into earnings. Like this is like, if you pay $1 for a contract and it doesn't work, then you lose the dollar. So at the end of the day, like your risk is defined by what you by how much you pay for it.
Okay, let's see. So how do you decide on exits for these trades? Like when do you decide? How do you decide it's time to take profits or cut losses if it goes wrong?
Yeah. So there's definitely a few factors that go into that. We actually had like we had like a good Facebook Live video, kind of like tackle, you know, part of like our because like with options are a little bit different than equities. I mean, like equities, it's like you're kind of like like you're selling shares, but like with options, like you can like kind of roll up too. So, we had a great Facebook Live video kind of talking about how we have like, profit targets. So 5%, 10% extensions. Great. We talk about how like like a lot of times you'll see us like instead of like completely closing out the trade right away, which I think we'll actually get to. We're going to talk about like a Twitter trade. So there'll be a lot of times when we will basically like for options it's like you're rolling. So it's like you can it gets to like a near term target, and then you can lock in money and like put on like you can put on your original risk. So you're basically like you're taking money off, and then you're keeping some risk on, but like you're cutting it back down to like the original amount. So it's like you kind of can keep you can keep like riding like the move, but it's about like managing the trade. So like trades like some trades, we're looking for like a a 5% extension, and then we roll to try to catch like another 5% on top of that, so like a 10% total. But then there's just like part of like mine and Kurt's experience is that we've been trading for a long time. So um, like exits are exits sometimes are intuitive things. It's like when you do it for a long time. I mean, there's sometimes when exits seem to be like they kind of clearly like smack you in the face, like it's like, all right, time to go. But then there's other times when it's like you need some experience to like tell you when to like cut them, cut and run. So
Okay,
um,
Dan, you want to take like 2 minutes and just explain this Twitter trade very quickly?
yeah, yeah. Okay, so kind of what I was referencing just a couple minutes ago. So um, so option trading, there's similarities, there's differences than regular equities trading. I mean, it like the thing with options is that you can it's like you're kind of constantly battling like time, like so like theta, like there's going to be like decay, and like your contracts are only for like a specified period. So there's definitely differences when it comes to like option trading, and but there's a lot of benefits too. So like Twitter it's a good example of a lot of things that we do. So Twitter when we first got involved, we got involved like back in November, beginning of November, right after they reported like a good number in October. So we got involved there because it was like a really nice technical setup. Like it stock was turning the corner out of like a long period of underperformance. Like it got through a huge technical level. So we wanted to get involved with it, like just for like a technical trade. I mean, so one thing too, like I also want to say is that like we do a lot of like technical trades and a lot of like different ideas too. So like there's a lot of ways to make money, and not every trade is a catalyst, but so like this is a good combination of a lot of things. So Twitter, we got involved originally as like a technical trade, and when our first position was like only out through January, it was a 22 call, and then as you can see in like the chart above, it's like when it got to like basically like a 10% extension from like our original entrance around like 21 or so, like hit like 23. So we basically we sold out, and then we rolled up. And what that means is that like, so we bought originally for 60, and then we sold it for 275. So you lock in, so right there you just lock in $2.15, right? And then what we did was with that we bought a March 27 call and for $1.35. So even if that March call expired worthless, we were already like in the bank, like locked in like a certain amount of money, right? And this March call, the reason we got involved with March is because it guaranteed it went out through earnings. And what you'll see is a lot of time, like what we do when we propose trades is they go through these events. And so for Twitter, we rolled it out to March. So we locked in money, we rolled it up, and kind of did its thing. Like the thing with like like a longer dated position is you kind of let it develop. You don't have to like sweat it, like especially when like a contract goes through like a big event like like the premium will kind of remain firm because it'll carry like this like extra. It'll carry like this extra premium always because like there's an event coming up. So with the March contract had earnings, so it kind of like did its thing and then pulled back in January, but then it ripped on like M&A chatter, and then going into the report, we held it going into the report, and so for two reasons. I mean, like technically it looked great, had a ton of momentum behind it. And looking at like a longer term chart, you could see like the next critical level on the upside was like 31, 32 area. So we thought that there was still plenty of room on the upside. And going back to the original trade, like it was kind of what you would say was house money, right? So we'd already made money on the January contract, and we locked it in. And so like even if this trade didn't work, it was the end of the day we were still be making money on the Twitter trade as a total. So what happened was, anybody that watched the markets last week, they saw like Twitter like had a big pop, and we sold that March 27 call for 480. So we made 215 on the original, made another like 345 on the next, and then actually we rolled up again, so locked in more money, and then we bought like an even further up call, like a 35. So it's like the whole way we're kind of like we're still riding it, right? But you're locking in money, so it's like if all of a sudden Twitter gaps down $10 tomorrow and the position's worthless, well, at the end of the day, I mean, we still made money on it, like the whole way up we've been locking it in and rolling it up. So and that's kind of what I mean by like with a little bit of difference between options and equities. I mean, you can't really do that. Like if you have 100 shares at 21, you can't, you can't just like keep like doing what we just did, and that's why like options are interesting, and they're just kind of like an attractive way to like go about this.
Oh, okay. So I have a good question here from our friend Sandeep. So since the market is a little crazy right now, like how are you planning out event-based trades when the market's going so crazy? Like how does that play into your decision?
Well, I mean, like sometimes what we'll do is like if it is crazy, like there's sometimes in like a strong trending tape, you can like have more confidence to get involved earlier, but when it's like kind of wild and you're getting like these 3 to 5% swings every day, you still map out like when the catalysts are coming, right? But you just may not get involved like 2 weeks before. You might get involved only like 2 days before, because like there's more of like a risk that the stock could have like a material move right before that catalyst, So like if you want to get into like a strangle for like an earnings trade, you might not want to put it on a week early, because there's a chance that the stock could have like a 10% move when the market's flying around like this. So you still focus on the events, but it's just more about the question of like the timing or like when you get involved with it.
Oh, okay. I just want to remind everybody I am shooting the links over to you guys so you have them. If you sign up, you will get tonight's newsletter at 7:30 on the dot. So you will actually have new trades tomorrow if you sign up today. Okay, so Dan, what kind of events are you looking for in the near future? Like, what are the catalysts you're looking to be trading?
Yeah, so I'm unabashedly, I'll admit it, I'm a biotech guy. There's for whatever reason, like biotech, there's been a lot of drug updates that seem to be kind of being pushed to like the end of the quarter. So like the next month, there's going to be a bunch of like real important drug updates. And we're also getting into retail earnings season, which I mean, the last I guess basically the last year, like retail earnings season has been, some of like the craziest trading of like the quarter. So I mean, basically the way earnings is like divided up, you get kind of like financials early, and then like kind of like tech and everything else in the middle, and then at the end of like the earnings season is when the retail reports start to come in like real heavy, and that's when they kind of like bunched at the back, and then we're going to start getting into like the kind of like the tail end of earnings, and that's going to be all of, like the retail. So there's going to be a lot of like you'll see there's going to be a lot of wild moves in retailers coming up.
Okay, so let's see. So is this for day traders?
Yeah, yeah. It works for day traders. It works if you're not a day trader. You know, like basically all you're gonna need is the ability to like execute a trade during the day. I mean, like it's not you're not gonna get flooded with a million alerts during the day. I can tell you that. Like you don't need to like you don't have to sit on like the edge of your desk like you know like trading every 10 minutes. But I mean if you're an active trader, I mean like there will be alerts. So you know it's if you want to day trade it, that works. And if you don't have the time to day trade, that also works because it's not going to be like you know every 2 minutes like a trade update.
Okay, so what we have some people from the VTF. So what's the difference between the trades you do in options in play and going on in the VTF?
So I've seen like a lot of times people on the VTF you know like I get asked you know like kind of like you know what I'm looking at or like different you know like you know they'll ask me like you know like what you know why I'm doing this like you know what's my thinking like you know what are your game plans for like earnings coming up and and basically like this is like a really good way kind of like it like lays out like the rationale like the thinking behind it kind of gives you like the charts and like the levels to watch you know it goes into a little bit more in depth about like the actual like the thinking behind the trade and you know like and Kurt's not and Kurt is not on the he doesn't contribute to the VTF so like you'll get a lot of like his input also so it's not just you know it's like the both of us, which you know on the VTF speaking during the day it would be just me. So like the input like the combined input and like the trades kind of like more expanded and like you know like you get like the technical levels.
Okay, so do you trade the I guess we'll call them volatility products like
Mhm.
VXX and SVXY and UVXY, all those crazy things? Do you do anything with those?
Uh, well, we did trade it last week, but we definitely do not like to trade them often. I personally think they're awful products. I think I'm pretty sure Kurt will agree with me there. Uh, they're miserable most of the time. Like 99% of the time, they're absolutely miserable to trade. And um, you know, I will say even as we like nailed it last week, like we got the you know we got involved with the VIX like right before it exploded, but just trying to get out of like the things was like a challenge. Like it's like it's kind of like you know 99% of the time they don't work, and then like the 1% of the time they do work. They make it so frustratingly difficult to like get in and out of the things. So that's why like you know if we're looking at like stuff like that, I mean like you know we won't like specifically trade the VIX. You won't see us do it very often. Um, it's only like really like great setups, and part of that reason is why is because it can be such like a real frustrating pain to like trade it. Like the option spreads like when volume hits. Remember like we were trying to get out of it last week, and the spreads were $5 wide for like you know contracts that cost you know like they were like it was like a $4 spread by like $11 spread. I mean it was crazy. Like you know makes it so difficult. But we like to focus more on like SPY like you know if we're gonna do like some like downside ETF bets, it'd be like SPY, DIA, QQQ, and you know like those are kind of more like our focus in that area.
Okay, so how many of the trades are like before events, and how many are after? Like, is there a specific kind of mix, or do you mean does it lean one way or the other?
Um, yeah, so uh, I we definitely have obviously like we have a lot of trades that go into you know we take a lot of trades going into like the events and then after I mean like there will be positioning so you know like if something like has like a big move, so like we'll either like either like roll, we'll either like take some money off and roll, or we can if it's moved against us, then we can kind of like try to like salvage and like trade out of it. But then like if we weren't involved with something and it had like a huge earnings move and it looks interesting, then we could like hop right in. So I would say that like more often than not, like we do get involved before, but we also have plenty of moves where like you won't have to take the event risk, and like there will be like just like a strong technical setup, and maybe like some other thing like unusual option activity, or like there'll be like some other like catalyst or interesting reason why we get involved. So like there will be plenty of ideas also where we don't necessarily have that event risk, and they will be they'll be after like earnings, or after like a readout, or after like an analyst event.
Okay, a few people are asking me if they need like a coupon code to get the $7 deal. Again, this is just $7 for 30 days. If you want to cancel, no problem at all. Zero hassles. Then you could figure out if it's right for you. So I just put the, if you click the link, you'll see this on your screen. All you have to do is scroll down, and at the bottom, you'll see the code's already entered. You don't need to do anything. Just fill out the information. Cancel at any time. There's no contracts. There's none of that BS. There's no hassles. There's no anything. All right, we're bringing it. Kurt Capra's coming back on the line. Okay, so Dan, give us I guess for both of you guys. Well, I guess mostly Kurt. So how do you guys integrate technical analysis with options trading?
Yeah, so I basically use a very, not to dumb it down or downplay it, but it's just a very simple approach to multiple time frames, moving average, volume. Nothing too fancy. I feel it's my opinion as though if you start to overcomplicate, if you try and look at too much, it just becomes more confusing than anything else, and really limits your ability to make confident decisions. So I'm completely focused on just the candlesticks primarily, more than anything else. What are the candles doing? What's the trend? Like I said, combining that with multiple time frames, couple moving averages, and letting the charts really speak to you and tell you what they're going to do. Not try and guess what's going to happen. But at the end of the day, we got to realize that we're trading other people's emotions, right? So we need to understand how those emotions are being reflected in the charts, and then know what to do to make money from them, from an options point of view in this case. And that's what Dan and I focus on, using those technicals and those emotions combined with all of these event-driven events.
Okay, so tell me about, I guess, what the ideal situation is. Are you guys like looking for a really like attractive event, like with a technical signal combined? I mean, do you guys ever do that?
Yeah.
Yeah, I mean, you want to take that, Dan?
Yeah. I mean, we'll I guess we'll both probably like address it, but yeah, I mean, it's kind of like I do think that often like for us, like the trades that work best are kind of like a nice blend of like great like great option like ideas, like or like great option like setups combined with like a technical, like an interesting like technical setup. So it kind of like lines up like, so like the Twitter trade was like it was kind of like something that like Kurt and I like it was like a really good, I feel like it's like a really good blend of like a little bit of everything that like just like works well. So it was like like Kurt spotted it as like a great technical thing, like a great technical setup, and then as it started to work, that there was like really like monster call buying. So it's like kind of like it hit my like scanner as like it seemed like that trader was starting to pile in, and then like when it got to earnings, like we kind of like as we kind of like dug more into it for like earnings, you kind of like say that you know, like there's basically like there's so much potential. Like you look at like a technical setup, and then like it's got momentum behind it, it's got earnings, and it's got unusual option activity. And right, Kurt, like I feel like it was like the trades that tend to work the best are the ones that kind of like blend like the like technicals and like these like you know like these like things that we look for when we like screen like option setups.
Yeah, for sure. I would totally agree. I mean, I think that when you start to get all those things coming together, part of what makes those so good is you've got so many people taking part in it, and that's why you got to understand things from both a technical side and also an option side, because I saw somebody asking questions about how you may look to trade the environment going forward, assuming that it goes sideways, right? So if the market's going sideways, how are you going to take advantage of something like that? And it's quite simple, looking for bearish opportunities when you're coming up to the top end of the range, and looking for bullish opportunities near the bottom, and anything in between becomes noise. And so Dan and I did something similar along those lines with the Apple trade. Not that we
Yeah.
haven't highlighted it here as an example that we walked through, but we were talking about it. We said, okay, look, Apple's come up to the top end of the range here where it's been rejected a couple times in the past, and combining that with the earnings coming up and its history to back off prior to earnings made sense to get involved with it at that point in time. So, that's a real good example of how we've been able to take advantage of something going sideways too. So I think one of the biggest things to understand with options, and specifically the way in which Dan and I approach options, is that it really makes no difference what the market's doing. The method that I use for technicals, it doesn't matter whether we're going up, down, or sideways, and then we use the options to complement that. So like I said, and as Dan was talking about before, you might not even have to pick a direction. If you just know that there's going to be some volatility in an area, you can take advantage of that alone. So combining the notion that we're going to do something from a technical level, right? Whether you're at support, you're at resistance, if you think it's trending up, if you think it's trending down or sideways, from a technical point of view, something's going to happen here. And then you go and find the options that make the most sense to take advantage of that movement, even if you just say, you know what, I don't know if this is going to go up or down, I just know it's going to do something. There's ways to make money in options, and Dan and I have been doing it. When we started this in 2017, September 2017, we've been doing it, and it's working real well.
Okay, so how are exits to the trades handled?
So you mean like when, or so it's like we.
So what happens? So if I'm an options in play subscriber, time to get out of the Apple trade, time to get out of the Twitter trade, like what do I get?
Yeah, so we will send an intraday alert that kind of like quickly like recaps kind of quickly recaps our reason for selling, or reason for buying back, or whatever it is, and then we will give you it'll basically say like a price to try to get out of it at, and they're timely. So like you want to act within like a relatively timely fashion, because like some of these are like price sensitive, but we do send like the intraday. We will send intraday alerts, telling you or recommending like when to buy or when to sell, and they will come to like your inbox. Yeah. So I saw somebody asking if we get text alerts, and unfortunately we don't do that right now, but I do think that has been something that has been discussed. I will say that.
Yeah. So just to clarify, yeah, some people are asking about texts. The alerts themselves are actually, they're very easy to read on a mobile device. Like, you don't
Yeah.
have to click a link and log into a website. Like, all the information is right there. And if you're on an iPhone or an Android phone, like, you could set up alerts specifically for options in play if that's what you want. So we just have two more questions. So what's the balance in strategies? I guess, how often are you using just like straight calls and puts, and how often are you using spreads?
Um, you know, I won't say that it's necessarily like perfectly even, but um, we do we do. I mean, I would say maybe like if I could just ballpark it, say like maybe like 60%. 60% are like straight calls or puts, and then after that, like the predominantly spreads, in some shape or form, like call spreads, put spreads, calendars, and then to a lesser extent well, I should also say like so like when I characterize like straight calls and puts, I mean that you could also that also like strangles or straddles. So, because
Okay. So some people are asking like when they're going to get trade ideas, and just to clarify, you get a newsletter every night at 7:30 p.m. and it gives you ideas for the next day. So you can figure out which ideas you like, which ideas you don't, and you'll have plenty of time to put your own plan together. And then the intraday alerts will supplement that. So if there's an update, if there's another trade, if it's time to get out, if it's time to roll something, like, you'll get an instant update. And again, it's $7 for 30 days. I'm going to shoot you guys the link again. Cancel it anytime if it's not for you. It's no big deal. But our subscribers are extremely happy because service is very profitable. It's very easy to use. You don't need a lot of experience. You don't need a ton of capital. You don't need to go on margin. You don't need to take a ton of risk. And you're getting like professional trades straight from our top professional options trader and a technical analysis guru. So please click the link I'm sending you right now.
And if I could just chime in too, as far as the balance of calls, puts, spreads, I think it's going to depend on the market conditions as well. Obviously,
totally.
with the way things had been, markets were going up, right? And now things are starting to change a little bit. So I think we're starting to see a little bit more in the way of spreads, things of that nature. But the bottom line is the way that Dan and I approach this is making it very simple and clear for anybody to understand what's going on, what we're doing. It's really for anyone. And I think that's the biggest thing, is that at $7 for the first 30 days, it's just a no-brainer that there's no, in my opinion, there's no risk involved, right? $7 to know if this is something that can make you significant amounts of money, which quite frankly, it's already been making people going back to 2017. So like I said, the calls versus puts versus spreads, that'll change depending on the environment. But Dan and I are going to set you up in a way that we feel is the most opportunistic way possible.
All right, so far we have 13 signups. Can we get 14? I don't want to end this on an unlucky number, so I'm going to shoot the link to you guys one more time. $7, 30 days. If you want to cancel, there's no contracts, there's no commitments, there's no annoying phone calls. You can get in and out. You can get in and out as easy as you do with these trades. Okay, and we got it. Okay, that's going to wrap us up for tonight. Have a good night. Thank you, Hank. Thank you, everybody who came.
Yeah. Happy Valentine's Day, everybody.
Appreciate it, guys.
Yeah.